Welcome to the Revenue Room podcast, where CEOs and revenue critical C suite executives leading businesses in the media, data, and experience economy come to grow. I'm your host, Heather Holst-Knudsen. Today, we're exploring funding model, or a new funding model, that's gaining serious traction among consumer brands and catching the attention of media companies looking to diversify revenue streams. And it's called Media for Equity. Our guest today is Diana Florescu, CEO and founder of Media for Growth, the principal international media capital fund. Diana is a Forbes 30 Under 30 honoree who cut her teeth leading marketing and growth at Startup Bootcamp and Rainmaking before launching MFG in 2022. Her firm trades advertising inventory for equity in growth stage consumer brands, creating a three-way value exchange between startups hungry for exposure, media companies seeking new revenue channels, and investors looking for differentiated deal flow. With partnerships spanning Sinclair Broadcast Group, Televisa, Univision, and media owners across TV, streaming, digital, print, and out of home, Diana is building the infrastructure for a new category of venture investing. Diana, welcome to the Revenue Room.
Thank you so much for having me, Heather. I'm really excited about this conversation. We were at your event, actually, during the Ad Week just a couple of months ago, and you got fantastic people in that room. So I hope they listen, and I hope this is useful for everybody.
Oh, well, thank you. That was Revenue Room Salon in October, and we were so delighted to have you. And you actually brought some great recommendations and introductions for us. So that was wonderful. But I'm actually super excited about this because when I came across your profile and what you were talking about on LinkedIn, I was like immediately intrigued. Like, what a unique way to drive value in that three-sided or that tripartite ecosystem that I just described. But for executives who may be encountering media for equity for the first time, can you walk us through the basic mechanics of how a deal gets structured, the benefits for the media brands, and the overall nature of your fund? It's just, again, I'm really so excited about the unique nature.
No, absolutely. And it's a great question. I think one thing I would like to start with is just a bit about the vision of the company. We've been around for about 4 years now, started the company back in the UK. So we grew a lot and we learned a lot, and we brought the fund here to the US roughly 12 months ago. And that learning curve became really, really steep. But from the very beginning, when I started the company, and we have a fantastic board of advisors and managing partners that I'm lucky because they've done this model in different countries such as Germany or India for over 20 years. And we had a shared vision of doing things differently and building a best-in-class team that would truly impact change for brands. And we envisioned a completely different kind of fund. As you mentioned, we are a media for equity fund that could really disrupt the current investment landscape and enable us to have a very hands-on approach to helping our founders and operators. So we didn't want to just pick the winners, but we wanted to have a real hand in helping drive positive brand outcomes for portfolio companies. And the reason I think this is important, I'm mentioning this, and in terms of how we structure the fund, is because these brands are essentially an extension of today's modern consumer, right? They're an expression of style, they're emotional, they have a voice, and we want to give them a voice in the real world. And it's our challenge to help curate those brands and really arm them with the most impactful tools to break through that clutter. And that basically reflected our whole strategy this year of how we want to grow this fund. On one side, you mentioned beautifully at the start the structure, right? So you've got broadcasters and publishers, and we're now expanding into experiential retail and streaming. So we have all these, great media companies, and their best asset is advertising space. And then on the other side, you have these challenger brands that are growing really fast, and there's only that much that programmatic channels can give you. So what we've done and how we structured this fund essentially is to use the assets, the media space of the media partners. You mentioned Sinclair, Televisa, we work with Atmosphere TV, we work with JCDecaux, we work with New York Post, part of News Corp, and there's many others. And we trade their advertising space for growth equity stakes in these challenger brands. And we can talk a bit more about exactly how it's structured and the valuation as well. But fundamentally, we empower brands to scale faster, get to profitability faster, and gain mass awareness at the same time optimizing their runway by using media as an asset class.
Okay. So first of all, what I heard is so you're not new as an entity. You are new to the US.
That's right. That's right.
12 months in. So I'd be very curious to dive into the learnings between what was going on in the UK and Europe and the difference here, if there are any. Typically there are. So I'd be very curious to hear about those.
A ton.
So
yeah.
So let's walk through an example first, though, so everyone who's listening really truly understands. So I'm a media company, and you approach me and you say, Heather, you want to invest in our fund? And I say, well, that sounds really interesting. Tell me more about it. And basically, my investment is actual advertising inventory that I commit for a dollar amount. It goes into the fund, right? And then your fund's value continues to grow based on the value of all of the various channels where inventory is being offered. As you said, broadcast, TV, retail environments. I think even we talked about there's a possibility, for in-person event inventory.
Exactly.
So that fund then has this mass asset of inventory. And then these consumer brands apply or pitch themselves to you to invest to get access to that inventory.
Yeah.
If they're selected to say, yes, we want to invest in you, the investment is X, millions of dollars or whatever it may be of the inventory across the brands where the inventory, the channel makes the most sense,
yes.
Right? And then so then the company, the consumer brand that got the investment now has given in return equity.
That's right.
Right. And the equity is shared with the limited partners who are the media brands.
Exactly.
Okay. I got it.
Perfect. Perfect description. Exactly. I think obviously there's nuances to the model, right? And I think what we're building here, it's not just a pure transaction for us. And that goes back to the vision that we had and we talked about, just building a different fund and really building for the consumer, for the modern brands of today. We have media planners in-house. We have creative production studios. We're fortunate to work with, AI creative studios that have been really riding this, innovation wave for many, many years, like Particle 6. They are the creator of Tilly Norwood, the AI actress. So when we work with a brand, everything starts with a media strategy and a brief, right? And like you said, we have all these different media channels we can tap into. But the beauty about what we do is that you don't have to feed all of them, right? What's your strategy? Like, what are you trying to achieve? And I think we can talk about an example later on, specifically what we've done. But we always take a DMA by DMA approach, right? DMA meaning a market. So we don't go, fully national blasting. Maybe for some companies that may work. But we take a very strategic market, like a fortress city approach. And based on what the brand needs, then we go back to our media partners who have a veto right, on where we invest. And that's where it starts. It starts with a plan, starts with a strategy. We want to deploy every media dollar, effectively in the end, because that's why the brands trust us. We want to make sure that, we have skin in the game. If these brands don't grow, then, that's essentially the beauty about this model. We do anything possible for these companies to grow.
So that's okay. So that's very interesting for a couple of reasons. But so you're basically, they're not just getting the inventory. You are literally guiding them and partnering with them and testing and making sure that the way they're approaching it is very, data driven, incredibly, efficient. They're not, because that's actually a big problem with young companies. They don't know how to. It's like throwing them into a candy shop and like, here, Let's go step by step. Here's the proper way to do this. So you're a value added partner, not just the
not
investor.
just an investor. Exactly. Not just an investor. And I think you're perfectly right. It's not just, there's a lot of headlines, and we actually hosted an investor roundtable just a couple of weeks ago from the time we're recording the podcast. And, investors obviously, change fundamentally how they invest and what they look for in the last 40 years, right? But it's not just because consumer companies tend to have a more challenging time at raising, which is true. There's lesser dollars going into consumer brands, but it's usually the knowledge and the expertise to be able to do above the line media. And it honestly, most of the time, it starts with a conversation about their brand and where they want to go. And then we go into the investment mechanics and structure later on, right?
So the value is actually and this would lead well into my next question, but the value then is really not just for the consumer brand who is receiving the investment, the opportunity, the guidance, everything. For the media brand who's then the recipient or the deliverer of the inventory, the value there is we're going to have a program for this consumer brand that has a high probability of great ROI and return for the brand, which reflects really well on the media brand. Because you're involved.
Exactly. So I think, and this is not just me outlining the reasons that our partners work with us, but there's a ton of research that we've done out there also about how this model has been performing for the past 30 years. So you mentioned at the start about the differences between Europe and the US. I think one fundamental difference is that this model has been deployed in Europe for over 25 years. And in the US, interestingly enough, it only started to become what we call institutionalized. So it actually gets on corporate agendas and is part of, discussions as part of corporate strategy, I would say in the last 3 years, 2-3 years. So we really kind of at the start there, but I think the benefits are really, I would say, threefold. If we ignore the investment for a second, these are challenger brands that never thought about going to TV or print or possibly even not out of home or radio. So I think what this model does exposes our media partners to a completely new set of advertisers that, I mean, rightfully so, their sales team would not have access to. So these brands are, spending a ton on programmatic. What we've seen is usually 30-40% of the revenue goes into Meta and, Amazon, if it's, it's a CPG brand or a D2C brand, or TikTok more recently. And they think that TV is just further down the line. They don't have the knowledge and the budget for it, right? So new set of advertisers. That would be the first. Second, and I guess this kind of feeds into the second reason, it's diversifying revenue. These advertisers grow and they become cash clients, right? So we at Media for Growth, we support companies that we invest typically over a period of about 18 months in different tranches, but we typically don't do follow-on investments. And that's also because these companies grow and, they can actually afford to pay with their own cash. So it's a great essentially source of really good quality deal flow for our media partners. It diversifies revenue for the reason I mentioned, but also these transactions are recorded as revenue. And majority of our media partners are public listed companies. And then, of course, the third reason, as you mentioned, I mean, it's an investment. Of course, there's also financial returns as part of this overall model. But I think the other thing it's important, I think, for media companies, to understand, there's, I would say, significant media space that is underutilized, whether we talk about TV or radio or print. And if it's gone, right? I mean, that space is perishable. You never get it back.
Yeah.
And I'm sure you have different ways of probably trying to sell it. Some obviously use Trade Desk or other programmatic platforms, but essentially you're getting cents on a dollar, right, for the media that you have. What we're trying to do here is to compound that value. So you're using literally the same space that would very likely go maybe underutilized, and reinvesting in these fast-growing consumer brands that obviously would grow and provide a return, right? And you develop relationships with them along the way. So it's a win-win.
No, I like my head's. There's so many of the brands that I see on, like, I'm like, she needs to go after this brand over there on Facebook. I see the ads all the time, and I'm like, what a great product, but it's the only place I see them. And but I can see how, as that kind of challenger brand, even just mentally thinking, can I cross the chasm from doing the types of marketing I'm doing right now to going into the big league, which is where they really want to go for more. Yeah. So I think that's really interesting. Now, so let's, getting into the actual value to the media brand. We talked about, it's the new customer acquisition. It helps diversify revenue streams. It gives you revenue recognition, especially if you're a public company, but revenue recognition across the board, I would think.
Yes.
And there's obviously the investment side, so longer term financial returns. So let's walk through, what does an internal conversation look like when you're pitching a broadcaster or a publisher or another one of your prospects?
Yeah. Honestly, I think, and maybe we as a team, we probably had, I would say without exaggeration, over 100 meetings like that over the last, couple of years. And of course, you explain the model and you explain the benefits that we just discussed. But if there's one thing that always moves the needle and we walk away knowing that there is interest to do it, it's the quality of the deal flow that we have. So I can spend hours, trying to explain complicated structures. But then I brought up our pipeline, and we have, I think this is the edge of MFG as well over other funds, because we have started in Europe and we have a lot of people on the ground. A lot of the deal flow into the US comes from international countries. We're looking at, UK, France, Germany. We just invested in a Switzerland-based company called Kayaks. We're looking at New Zealand. So when we put up that deal flow and we explain exactly, this is the brand, this is how exactly it's going to fit your media properties, that really, I think, that moves the direction in a completely, the conversation in a different direction altogether. So obviously that's kind of the start. And then from there, we really truly want to understand their media properties. And in the end, again, we cannot work with a brand if we cannot add value. So we have a very clear strategy of what media partners we have to work with, for example, into 2026, because of the deal flow that we have coming through. And we explain exactly what the value is, how much we're looking to deploy, so they already can start planning, okay, let's say $10 million, that's what I'm looking to make in revenue from Media for Growth, in 2026. And these are the first advertisers that we can already start working with. So usually it always starts with a corporate development team or, chief revenue officers, CFOs. And the moment, they understand the benefits and the model, then we start working with the ad sales teams to work on specific brands and use cases.
Okay. So what just follow on with that, what is your ideal media partner look like?
It's a great question. Yeah. I think for us, and the objective is to build the most diverse stack of media in America. And we also have to keep up with all the changes that is happening right now in the media space, right? So an ideal, and we cut across TV streaming, out of home, digital TV. I mentioned retail media and expanding further into local digital news. So we pretty much try to tap into all of this, but I think an ideal client is a client that has sufficient reach, right, across the country. And a client that, well, because that would work for them as well, they do want to grow and they are excited about the challenger brands, right? Because they know that's going to give them an edge. And you can see that
Yeah.
through their different initiatives. So I'll mention like Sinclair and Televisa Univision. I call them early adopters because they backed us from the very beginning. And the reason they've done that is because on their own, they also deploy media. So Sinclair has Sinclair Ventures and they deploy media for equity. Televisa has Union Bravo and deploy media for equity. They already see that this is a model that works for them. So I think having conviction and having sufficient reach and quality media in the end, obviously that's very important. I think that makes it an ideal client. And then of course, we're looking to grow into specific channels next year. So then we're looking at, specific companies into those channels. But before we segment the market, that's like the top 2 or 3, I would say, considerations.
So the thing that keeps going in my head right now, because I remember you posted on LinkedIn, I think one of your consumer brands that you invested in is it Lab Grown Diamonds?
Yeah.
It was something about, right.
That's
yeah.
right.
So, and the reason why I was fascinated by that, because I bought my first pair of lab grown diamond earrings and I was like, very skeptical about it. And you had to get, but it's like everywhere now. I mean, lab grown diamonds are causing a lot of problems for the real diamond market, but that's a whole other discussion. But with that said, I'm saying, okay, so if the customer is your portfolio company is Wolf, the lab grown diamonds, I'm thinking to myself right away, like, well, all of the B2C Hearst brands and Condé Nast brands would be great media for them. Like, would they be a good partner for you in terms of an investor, a media investor?
I don't know if it's a trick question, but yes, they will be a great partner. I cannot disclose fully, but there are conversations happening, and also with counterparts, I guess, at the big digital print publications. But yes, absolutely.
Yeah, and it wasn't a trick question at all. And I was actually where I was going, which is the print side, right?
Yes.
Because and I was curious because let's just use Vogue, for example, or it's the one that comes off the top of my head. They would have to see that, yes, this is really great. We want to get these new entrants in, but I would think they would also want to say that we need to know, or for us, it's important to know that, Wolf, lab grown diamonds, this consumer brand, let's just use as an example. After the investment's over, our idea is we're going to be able to keep that customer and that they'll be able to afford our type of advertising after.
Yes. So I think absolutely. I mean, that's exactly goes back to one of the main objectives, and I think one of the reasons existing partners work with us, I think, is developing those relationships early on. And it's not something that we're seeing just on traditional media side. Everywhere you look, whether you look at media agencies or you look at barter agencies, everybody, or even creative agencies, everybody right now is having an objective or is trying to think about the business model of how they could serve smaller brands, because they are the ones that are, a lot of these brands are born and raised on digital. So you obviously have to adjust and you have to think about how you're going to serve them, right? It's a completely new set of customers. So that's obviously a very important, consideration, right? If these companies do become cash clients, right? Can we continue to serve them? Can we still reach their audience? Can they afford our media? Absolutely.
So let's get to the actual dynamics of the investment side, right? Because from what I learned, your fund invests around $5 million per deal through safes, convertible notes, or equity. But there needs to be an exit, right, for that to materialize into the X factor value for the investors. And these are consumer brands, so very different than SaaS or tech. How do you think about valuation with consumer brands, and what are the typical exits for these kinds of companies?
Yeah, so I think we typically this year we invested on average 3 to 5 million in a campaign. So again, we normally invest over a period of 12 to 18 months. We're talking about 3 campaigns, 3 tranches. So we could invest, for example, up to 10, 15 million in a single in a company. And all the instruments that you mentioned, obviously we would prefer a price round. We usually come in as a strategic investor supporting the lead investor, right? So we don't necessarily price that round. I think in terms of valuations, so the way to achieve that liquidity, I think that was the first point. I think there's a number of ways, and it's not just IPO or the companies necessarily getting acquired. I think there's other elements for us to consider, and obviously we have a duty to our LPs. If there are times where there are great economic times, then we would consider a secondary sell because for example, LPs may also need cash at the time, or we do believe that that's a great deal. We would do it, right? So we have the possibility to do that earlier on without necessarily waiting for an exit event. I also think, what's been happening in the market for the last 3-4 years, the IPO market, especially for consumer, has been, pretty sharp. So we're already looking and developing relationships with other different strategic buyers without necessarily just relying on, an acquisition or an IPO in that case.
Okay. And how do you define a strategic buyer?
Strategic buyers could be, so there are right now, I think if we also look at some of the reports out there, right? A lot of the LPs have, went down the secondary route in the last 24 months. There's different, there are big secondary funds, but I think we have to, you always have to be wary that it's probably going to have a pretty steep discount. But there's also some other strategic smaller platforms, I don't know, Republic, for example, or smaller individuals that are strategic and you could sell into. And I'm mentioning this because we normally take minority stakes in our portfolio companies. So we're not a major investor, we're not a lead investor, and we wouldn't take a board seat, right? So we would possibly take an observer seat. So that also gives us a bit more flexibility, right? In terms of the equity that we have in the sell.
Got it. So let's move into a specific use case or example of how one of your portfolio brands utilized the media access you provided them to accelerate growth, in ways that traditional funding could not have achieved.
Yeah, I think I would probably think of Kayaks because, the campaign went really, really well. And I think it's a great example because of the diversity of the partners we had reflected in that campaign. So this is just a bit about the company. This is a Swiss brand. They are the first cortisol reducer in a form of a beverage. So you consume Kayaks after a heavy workout, or you possibly have a hectic life, and we're branching out into this space. If you have a hectic life, if you're a professional, maybe you're a mom, and you're trying to juggle different things, very likely your sleep sometimes gets altered. So what this beverage does, and it's clinically tested and backed, it reduces cortisol in your body. And cortisol is great, up to a point and not for a long time. And if you are working out, frequently, you need to recover. So on one side, it improves the recovery space, and at the same time, it improves your sleep. In Switzerland, they are the best-selling product. They've been around for about 10 years, so they have great brand and great positioning in Switzerland. They've been very new to the US. They expanded here about a year ago. Started with Equinox in California. That went really well, and then the partnership extended to New York. So that's when we met Pedro and the team about 6 months ago. And the campaign performed on all counts. And I'll explain what I mean. So the objective was to obviously increase sales. They were a pretty new brand to the US, but at the same time, we wanted to build up their retail distribution. And that's an important point, which if you want, we can cover later, how we evaluate brands and how we think about weighted distribution proportionate to their media spend. We were very surgical on New York and California for the campaign to where we focused as the DMAs, and we went
Mm-hmm.
after what we call recreational athletes. So very well defined audience, very well defined objective, and very specific onto DMAs. We had participation from streaming and connected TV were the driving channels. So we partnered with the tennis channel, and Kayaks was
Mm-hmm.
featured in all the US Open tournaments and the games. And then we paired that with contextual advertising. So bus shelters through JCDecaux outside all the major gyms, and cover apps with New York Post, and editorial and sports shorts activations. So in a course of 4 months, the revenue increased tenfold. The company opened up about 400 different doors with retailers. Some are smaller, some are talking about big gyms. They're one of the best-selling products in Feed.com. They got listed in GoPuff, and they had the best Amazon sales throughout, like globally speaking, and their cost per acquisition went down. So that's another very important metric that we look out for, because they do spend a lot on programmatic, right? So their CAC tends to go to the roof when we start the conversation with these companies. So we try to see how the brand performance actually impacts their CAC in the end, and that was the key metric that we looked out for. It went so well that, anyway, long story short, we're doubling down. So in about a couple of months, we're starting another campaign and looking at a couple of different DMAs. So we're really, really excited about that, and adding a few more channels this time to the campaign.
That's really an incredible use case, and I've got 1,000 questions on my piece of paper in front of me right now. But let's go to the one you brought up, because I do think that's really important, and that is how you evaluate the brands. Like how does that process work, and what are your critical criteria?
Yeah, so I think I always like to segment them into more like pure financial criteria that any other investor would look out for, and media and media relevancy, and can we actually add value to this brand based on where they are in the brand life cycle. So if we start with the financial metrics, we normally invest in companies that are growth stage. So what that translates to 5-7 million in annual recurring revenue, looking at on average 12-18 month runway. We're looking obviously at CAC to LTV ratio. We actually look at burn. So burn is almost becoming kind of the definitive financial metric, if you like, even more so than revenue. And then depending on, we talk about consumer technology company or a CPG, obviously we're also looking at retention or revenue sales, retail sales velocity. So those are kind of the financial metrics, right? But I think even before we go deeper into those, the question is, can we actually move the needle for this company? And we get asked every time. I think this conversation comes up in all my, the question comes up in all my conversations with the brands. How do we know where to spend our marketing? And are we ready, for example, for TV? And if we're talking about a CPG company, so consumer company that is building up their retail distribution, I always look at, or we look at, two metrics: the weighted distribution proportionate to their prompt and brand awareness. So I'll explain what that essentially means, because the intersection of these numbers, it's a fundamental question, really, that all founders and senior marketeers should always wrestle with. I believe that until your weighted distribution is about 20%, right, in that given market, let's say you are in New York and you have less than 20% distribution, it's unlikely to really make sense to spend on above the line media. Maybe it might make sense to do a very short test activation out of home, perhaps in a specific place outside of your retail shops. Sure. But I think to go full blown above the line, I think that that won't be efficient. At the same time, if your distribution is over 30-40%, and if you're not spending on above the line media, then essentially that puts a lot of pressure on acquiring customers through programmatic. And in competitive spaces, I'm talking about travel or even food and beverage, the CAC, it just goes higher and higher and higher. So then it becomes inefficient not to spend. So we always look at the weighted distribution and the prompted brand awareness for these companies when we assess. And I mean, again, it's not a one size fits all, but because for us, we do invest mainly in CPG and we have some consumer technology companies too, for the retail distribution is absolutely key to ensure that we can actually provide value through the channels we have.
Mm-hmm. Mm-hmm. Well, okay, so you bring up consumer tech, which is I didn't realize you had consumer tech. And so now I'm thinking to myself, in the world of consumer tech, from a nationwide perspective, getting into one of these big the biggest trade show is CES, which has a B2B and a B2C component. Like, that's a groundbreaking moment for a CP, like for a consumer tech brand, is one of those types of shows where they break ground and they get and then they continue doing it. Have you thought of bringing in events, for example, as part of the investor class?
We did, I think, and I think it's also depends what we mean by events, right? Because events can take different forms and shapes. Like obviously, you know very well, some other media funds that we know of they are using their own events. So, for example, Financial Times in the UK, they have their media for equity arm. They also throw their own events as part of the mix, and that's more relevant for B2B companies. They want to tap into C-level or let's say financial institutions, insurance companies. I think for
Yep.
us, so the way I would translate events, and it's happening pretty much as we speak, it's activations, right? So imagine you're going to a shopping center and you see Kayaks and you see a stand and you see the brand ambassadors right outside of Lifetime Fitness, and handing out the samples, doing a plank challenge. It's not obviously an event in of itself, but it's an activation in real life. And with all the
Yep.
AI and what's happening right now, I think this is actually going to become one of the key driving channels for brands moving forward. They need to have a real presence in real life. So
Mm-hmm.
I do
Mm-hmm.
think events play a pretty important role as part of the overall mix.
Okay. And then, but that also, you mentioned something interesting about that in that use case, uh, which is you not only helped them gain, you brought their CAC down, got them huge amount of exposure, wildly successful campaign, not only with the consumer, but with retail distribution.
Exactly.
And so how did the retail distribution angle?
Yeah, so I think and it's always kind of a bit of a chicken and egg problem because um, in a way, so I'll give you an example. So we have companies that are listed in 250 Whole Food stores, right? So it's definitely not a national listing, but it's a pretty substantial listing. And you're thinking, where do you want to place or where do you want to advertise? Do you want to advertise mainly targeting those stores where you're already in because you already technically got them, or you want to look at branching out into a different state where you're looking to extend your relationship with, let's say, Whole Foods? And I say it's a chicken and egg problem because retailers they want to see that you have sufficient marketing spend behind you to sustain your positioning on the shelf. And especially with a retailer like Whole Foods, it's hard to get
Mm,
in, but the competition is pretty fierce. But at the same time, for you to get those retailers, you also you need to show that, you have marketing engine behind you. So what we've done with Kayaks, we were very, very, again, strategic to place their advertising right outside more premium fitness centers in New York and get the actual managers to test the product and provide samples to their customers. And customers loved it, right? So that's how you basically get some of the retailers to pay attention, and then they've seen, okay, this company basically has a $2 million budget behind them to help them grow, and that was the
mm-hmm.
value of the campaign. So it is a bit of a chicken and egg problem. I think a lot of, and this is not new, I think what I'm saying, a lot of these brands start in one market. They build a very good use case with a major retailer, and then they expand from there. And that's exactly the strategy that we have with our media spend.
Again, I'm just gonna again, I can't help myself with events, and I'll just use kayaks. And all right, so we have, there's this whole group within Informa called Natural Products, and they've got two of the largest shows, East and West, and companies like Whole Foods, and they go there. Like, I would think that could, if getting distribution channel is and they have your backing, which is the we have the spend behind us and the expertise, that could be a great place for them to go. And they might do that on their own, but yeah, but okay.
I think Informa, it's interesting you brought up, you talk about same Informa, for example, they own Super Return and they own some of the other events, right? In Europe. Okay. Yeah, I mean, Informa, honestly, I think, sorry, this is like, it's a bit of a sales pitch to Informa at the moment, but what we built at MFG makes so much perfect sense for them. It's, yeah.
No, I think it's honestly, so I'll pitch it to Informa too for you, because it's really, to me, it's like they all need new types of customers. So they need to expand, they have to go long tail. They are publicly held companies, so they can recognize it as revenue. They're building out incredible data infrastructure to surround, that can be deployed through media assets, by the way, not just the live event. And again, and it's one of the things that, people, they realize, but they don't realize that live events for so many companies are like, it kicks off their whole success story. It becomes a major part of their marketing, and they must do them. So, but sometimes for some of these, if they don't have the juice behind them, both in terms of the equity or the cash to do it, but also the smart marketing around it. It's not just enough to buy a booth. So anyway, a lot to discuss there.
No, I couldn't agree more. And look, I think the way we've grown MFG, and obviously we've been here for about a year, but we've done a lot more in the UK. I was just very specific with where we obviously put our dollars in terms of marketing channels. And for us, events pretty much grew this business. We do 6 to 8 events a year, from smaller roundtables to bigger capital summits, media capital summits, and that really built this community for us. So I think it's a perfect channel. I think I'm always intrigued about looking at how we could value the contribution, and I think also with events, the ones especially that pertain more to executives or enterprise, or if you're a company, I mean, we're looking at a couple of insurance companies that would also like to sell into B2B. I mean, those would be great distribution channels, right, for those companies. I would argue even more so than a broader consumer space. So specifically targeting, those folks that you probably pay $300,000 on LinkedIn to target them through ads. Yeah. Absolutely.
Yeah. So on the flip side, I'm curious with, do the media companies have a say? Like, do they say, well, I don't want that advertiser, or you shouldn't, like, how do they get involved with, one, who you invest in, and then two, once the investment takes place, where the ad spend goes?
Yeah, it's a great question. And I think this has to do a lot with how we structured our fund model. And although our media partners obviously give us the credits and they trust us to, deploy it best, they always retain a veto right. So imagine we spoke to Kayaks, and this was before the investment. We always create a use case. And after we do the media plan internally through our team, we go back to the partners that we believe would make most sense to be reflected in that deal. So they always have the right to participate or not participate. Now, it never happened to get out of a deal. I think that right is also, like you said, they have control over the media, and I think that's very important. I think it's also about reputational risk management as well, and avoiding any possible conflict of interest, right, with existing advertisers. Like, we're talking to retail partners that may work with Coca-Cola, for example, right? Or have exclusive rights with certain brands. And that's very important. So we take that into account. And yeah, once that is, approved, we work very closely with the sales team. So they have a direct relationship with our brands and create a plan that makes more sense for the company.
Okay, really, really good answer to that. So that was very informative. So I got to move into the data and analytics layer because not only it seems like you've got it's critical to proving the ROI. Not only the ROI, I think it's critical for the where to place, right?
Yeah.
Because you got it informing decisions. And you're speaking at Revved Up, which we're very, very grateful to have you join us in March. And one of the things you'll be sharing is at your own research that you do. So, one, talk to us a little bit about how important it is in terms of how you're using data to inform decisions, but also the actual research you'll be sharing with us in March.
Yeah, so I think the research, a lot of the research we've done is related to how the model performs and how this investment vehicle essentially performs for both brands and our media partners. And there's a ton of information there. I think just to provide a summary, there's over 35 unicorns to date that have grown using media for equity early on in their brand lifecycle. Companies like Airbnb and Uber and Zalando for everybody listening from Europe, or Rappi, in Latin America. But another thing that we're seeing, which is very interesting, is the survival rate and the exit returns. The exit rate compared to even a typical cash fund. So about roughly, I would say 30% of, and again, it's a small, we talk about a very small number of investments, right? So maybe I should probably take a step back compared to the venture capital industry where we have, hundreds of millions of investments done in the last decades. But here it's a 25-year-old model. So we're looking at roughly 700, 800 investments completed in 25 years. So I would say if the media industry is roughly $750 billion, less than 1% of the space has actually been used through a media for equity investment. So small, early stage, small. But what we're seeing is that fantastic exit rates. So about 30% of the companies that have actually raised have exited, and about 7% of those through an IPO, which is a good metric. The other thing that we're seeing is the path to liquidity. So we actually looked at the companies that have exited, and then we compared that with same amount of companies, and we went through their S1 forms. And on average, the ones that have invested in brand building early on, they exited roughly 12 months faster than their counterparts. So that it's important because in the end, you're thinking about returning cash back to your LPs and to the investors. Now, when it comes to the data part of our investments, it's a great question, and it's a topic that we are constantly iterating here at MFG. More recently, we appointed Carol Hinant, who was the Chief Revenue Officer at Comscore. I believe actually she also attended the event.
Yes.
Yeah. And I mean, she's fantastic, and she's really empowering us to create our own measurement framework. Obviously, we work very closely, Nielsen providing us the performance of these investments. And just recently, we also had Video Advertising Bureau involved in some of our events, and they have fantastic data for first-time advertisers. So it's a great topic. And frankly, we're not perfect, right, at what we do. So we want to become even more data driven than we are today.
So Carol will be at Revved Up. I just emailed her, so that'll be great to have her there with you.
Awesome.
Two, it sounds like venture capitalists, the standard kind, should be extremely excited about companies that do this because of what you said, that if the companies who invest in brand early on they exit faster, and I wonder if the valuation is actually higher. So I would say that there's an angle there.
Yeah.
But what the other point you just brought up is that you're saying 1% of all media is that just 1% versus how much inventory is wasted, like that could
Yeah.
be used. Like that could be a very interesting metric to
It's a
showcase.
it's a great one. I mean, it would be an interesting, actually, let's say, hypothesis for a great study. What is the waste,
Yeah.
right, of,
Yeah.
um, I guess, the broader industry, which obviously differs quite a bit depending on channels, but it's a very good point.
That then, if deployed through a fund like yours, that could be converted into real exciting revenue and equity.
Yeah.
So, all right. Unfortunately, we're running out of time, and I have more questions, but I'll save those for Revved Up. But I guess the one thing we'll end with two things. One is our rapid fire right at the end. But the last question I'm going to ask you on a serious nature is, what is the one thing you wish more founders understood about building a brand through media capital before they walk into a pitch with you?
I think it's actually more about to do with related to brand building than just the investment itself. And I would say thinking of brand as your performance channel, and think about, and even if you are, let's say, at seed stage at the moment listening in, I think you need to start already thinking about how you're going to build your brand. And that's actually one of the, unfortunately, some of the, I guess, the mistakes we're seeing, or I saw previously before starting Media for Growth. A lot of companies tend to start thinking about brand building when they raise their Series A, Series B, right? And I think that comes from the same challenges we talked about. Could be expertise, could be knowledge, could be accessing, using media effectively. But I would say, yeah, think about your brand, or investing in brand building. It's actually a performance channel that is going to trickle down to your performance channels as well.
Yeah, I bet you cash flow has a lot to do with it too, because it's growth at all costs almost, like to get cash in the door if they don't have the right funding. So brand kind of takes a back seat. So, all
Although
right.
I think
Oops, sorry.
investors, I think, are thinking, are changing definitely their expectations of growth at all cost. I think that was, if I could summarize the investor roundtable we had like 3 weeks ago, it's all about burn, burn, burn. So if you are any excessive burn, I would say, sounds very harsh, but it's like not tolerated anymore. I think all investors walked away, and like that's what we're looking out for. It's about burn.
Yep. Yep. All right. So I do a couple of fun rapid fire questions before we close out. So and I actually have one I really want to ask you after my first two, but my first one always is coffee or tea?
Coffee. Too much coffee. I think.
Sweet or savory?
Savory.
Yeah, I'm a savory person too. All right. And then, given your background, what's the most interesting place you've traveled to?
I think that would probably be Olbosch, the island. It's an island in
Where's that?
Mexico. So you fly to Cancun, and then you basically take the ferry there. It's just paradise. If you really want to, disconnect, well, I mean, turn off your Wi-Fi, because they do have good Wi-Fi. But if you want to disconnect, it's a small island. And all you do is just to relax and have great food. That's amazing.
That sounds great. I've never heard of it. I have to look it up. Well, thank you, Diana, for joining us today. It was a terrific conversation. And for those of you who'd like to connect with Diana and learn more about Media for Growth, we will include her LinkedIn and URL to her website in the show notes. And just a reminder that the conversation doesn't end here. It continues inside Revenue Room CXO, the only network where CXOs and their revenue critical teams turn AI disruption into growth strategy. And if you want to experience all of this live, join us at Revved Up 2026, which takes place March 23rd through the 24th at the Vinoy in St. Pete, Florida. And it's where we'll discuss the future of data, AI, and revenue leadership. And we'll put both links in the show notes. And don't forget to listen to us on Apple Podcasts or Spotify or YouTube, and like and share our show. And see you next time. Thank you.
Thanks so much, Heather.